I'm Cesar Delgado from Back Roads of Illinois. Our guest today is Mike Zuzolo from Atchison, Kansas. Out of Global Commodity, he is the president of Global Commodity. How are you, Mike?
Doing well.
How do you see the acreage report on March? Could you explain to the audience about this report?
Yeah, I would say in the acreage for 2024, while we know a lot more about the winter wheat acres, because USDA's fresh estimates pulling down the acreage base, which I think is pretty accurate. I'm in agreement with them on that because they didn't pull it down too much. And the reason I think the wheat acreage is going down is because the cash basis situation has gotten worse. So the net selling price for this coming summer for 24 wheat, especially soft red and even hard red wheat, are not going to be nearly as attractive as in 2023. The corn and bean acreage base, though, I can tell by other media people I've worked with and panel meetings I've been on with other commodity analysts. I'm probably a bit of an outlier and a bit of a contrarian in that I think we're going to see a lower corn acreage base by possibly 3, maybe even 4 million acres. And the soybeans would react to a higher acreage base. I'm suggesting that partially predicated upon history when we've had the big corn, small bean acres in the next year and the rotation side of the equation. I'm also suggesting that because the bean corn ratio, the November beans divided by December corn, is still sitting at about a 2.5 times premium, 2.5 times premium for November beans against December corn futures. And I think since we complete the crop insurance base price in the month of February for new crop using the November beans and December corn futures, I think if we stay at that price level where the beans are 2.5 times higher or more than the December corn, we will attract more bean acres yet again and not as much corn acres. And I'm suggesting that, Caesar, because in part the cost of production is so different this year in terms of corn versus beans, and there's just not a clear pathway to get a big profit in corn like we've seen the last couple years. The last thing I will say, and this is a little bit more anecdotal and a little bit fuzzier from an analytical perspective, is that I've talked to producers this past month in January who've spoken a lot about what they have in corn in the bin for 2023 crop and how that's not making them money anymore. And then they, as I said, don't have a very clear path to making much money compared to beans in 2024. And so it seems like there's an element of both crop years weighing on them when it comes to the corn. So I would say the soybeans in November, for me, going into the end of January, are carrying a premium against December corn. And that premium probably shouldn't be there at the end of February unless we get confirmation from USDA that we've got some problems in Brazil's soybean production that neither Argentina nor Paraguay can offset and compensate for.
Battle of the acreage for this year.
Yeah, and that's what we're setting up for. I think this is what you say is very appropriate from a standpoint that I could see the February base price for crop insurance being maybe the single biggest determinant upon our actual acreage base in 2024, just because of how tight the cost of production versus profitability is at this stage of the game. It sounds like that it's going to cost about $800 an acre using a $200 to $250 cash rent land payment. It's going to be that high this year for getting corn planted. And so can you make over $800 an acre gross revenue on a good corn crop? And that's the big question mark, because we're dangerously close to not doing much better than 430, 440, 450 in December corn. And if you see that number slip anymore, and will actually compensate and more than compensate for the lost Brazilian bushels. I'm not so sure about that because I think we're right in the heart of making or breaking the Argentine corn and bean crop and the Paraguayan corn and bean crop at this point, Caesar. I'm I'm confident that the soybean crop potential has been probably secured in terms of not losing too much more in Brazil at this stage because of the recent weather since the beginning of January. It's done a lot of good in a lot of areas. There are still some dry pockets in Brazil, but I'm going to focus mostly on Paraguay and Argentina because most of the trade that I speak to or talk to or hear from really are honing in on the idea that we're still going to see a 205, 210, maybe even more million metric ton soybean production when you combine Brazil, Argentina, and Paraguay. That may be, but I don't think we've done that yet because we really are entering a critical phase. And I think that was part of what we saw on the trade on Tuesday, the day we're recording here after the market closed. I think the weather in Argentina and Paraguay is getting more attention, and that spooked some of the shorts in the market. But I think the bigger issue is what was happening with the International Monetary Fund bringing up China's growth. I think that was a very big shock to the market. And I think a big reason why we've been breaking the commodities in agriculture, grains and soy, has been because of the fear that China is going to be terribly deflationary and export their deflation into the rest of the world, kind of like what Japan did back in the 1990s.
What is your opinion on this World Agricultural Supply and Demand Estimate report on next month? We passed on January's report.
Well, there should be fewer surprises because there's fewer numbers to receive. You know, we're getting the winter wheat acres, we were getting the WASDE report, we were getting the grain stocks report, and you know there was a lot of information coming at us in January. Since the weather's improved in Brazil, there's less weather premium in the soybeans, and so a surprise by USDA from a standpoint of a lower crop in Brazil I think would have and could have an effect on the markets. Right now the USDA is sitting at 157 million metric tons for soybeans as of their January report, and sitting at about I think a 107 million metric ton corn production number for Brazil. I'm sitting at a 154 million metric ton soybean crop. I will take that down pretty dramatically in the next 2 weeks if we see any kind of weather issues redevelop. Again, I'll be looking at the Argentine and Paraguayan crops just as importantly, but I feel pretty good about the 154 number in soybeans. In corn, I'm sitting at 118 million metric tons, and that's really in February for that WASDE report, Caesar. I really feel like USDA and the trade too did not scrutinize the numbers nearly as much as they should, because if we are, say, 9 million metric tons less in corn production in Brazil than what USDA gave us in January, it's going to be very hard for. This is an important thing in the aspect of the analysis that I've been doing and meetings I've been giving to show my research to clients and farmers and ranchers, is that, as I said a minute ago, I think China has really been a big issue in this market, bigger than we realize, in terms of keeping the prices weighed down and the trade in the grains, especially rallies being sold very quickly. Tuesday's close seemed to be a bit different. Again, I think it's because the IMF came in and raised China's growth 0.4 of a percentage point versus their estimate back in October, up to a 4.6% GDP in 2024. That to me was a very big number, and I think the trade felt that way as well. And if you notice what happened in the Tuesday trade, before the grain prices kicked off, after that IMF data came out, it was really about the copper, and then it was about the hogs, and then it was about the soybeans. All three of those have a very close relationship typically, and in my opinion, pretty consistently with China and the sentiment of the Chinese demand and the commodity markets as related to China and Asia and the other emerging markets. And so when I saw the soybeans, hogs, and copper go higher, and then the rest of the market.
How is the cattle markets for today?
I think we continue to see a different feeling and a different sentiment in the market. And the missing link in the grains versus the cattle and hogs, especially the cattle market, Caesar, has been, in other words, last week, fat cattle closed up about 5%, corn closed almost steady, just barely higher on the week. Why would you have that big of a difference? What would be the common denominator between those two being so different? And I think it really does go back to the demand side of the equation. We had very strong export sales in beef. China was our number two buyer. The winter weather here in the United States has created some supply issues. We've got the wheat pasture back in the southern plains. That means cattle, calf prices are really red hot again. And we're trying to rebuild the herd now in the southern parts of the country, like parts of Texas and Oklahoma, and even southern Kansas, my state. I think this is where, if you look at the supply demand fundamentals, it's not nearly as negative because of the demand side. And obviously, we have a tightening supply as well. And so there's less concern about China because of the supply demand fundamentals. Plus, the export demand, as I said, for beef, China's still right there with the market as the number one, two, or three buyer pretty much every week or almost every week in the last couple, 3 months. And so that has been, I think, the major difference between the grains and the cattle market, especially. Hogs have been able to rally, I think, in part because they are maybe seeing the liquidation phase in both the United States and China as being over. And as I said earlier, I think this recent move up in the hogs on Tuesday, probably due to the International Monetary Fund Chinese growth outlook that they updated and really changed, I think, the market look and expectations of where China was headed, that maybe China is bottoming at this point. So I think that's where the cattle market has got a premium in it. It's a valid premium, but I think this is where in 2024, when I'm out on the road, like I was in Nebraska last week talking to a couple hundred cattlemen and farmers, and I made the point very clearly that 2024 is not about what high you sell it at or what price you sell your cattle at or lock your feeders in. It's being profitable throughout the whole year, because I do think that it's going to be more difficult for the fat cattle and the feeder cattle to stay elevated and stay in an uptrend like they did in 2023. And that especially goes to the point of the feeder cattle market and the way the funds trade when it comes to feeder cattle and corn. We've seen again, as we've gotten into 2024, a resumption of buying feeder cattle and selling corn. We're back up near the highs from late last year on that feeder corn ratio. And if the corn market would decide, when it decides to bottom, I think that right there, that mechanism of unwinding the feeder corn spread is something that could take the feeder cattle down. So I think it's important to keep your hedges in place and just think about profitability instead of selling the top end and the highs.
When we could see the cattle expansion in the United States, we talked about it before the holidays.
Yes, exactly. And I think we are starting to see the retention take place in the US, and I would even say in Australia. They have liquidated because of El Nino. El Nino was not as bad. They got a lot of rains in December and January, and I've seen several articles and comments that the cattlemen in Australia are wanting to get back to retention and build their herds back up again. But as we know, the cattle cycle takes a couple years, almost 3 years, to really get it from the calf to the marketing side of the equation and out of the feedlot and into the packer and into the slaughterhouse. And so we're just on the beginning stages of that. I think the one thing that we have to keep an eye on that is very important from a standpoint of what made the 2015 market so weak, even though we were starting to rebuild our herds and the supply was going down, slaughter was going down, we still lost premium in 2015. The big thing, I think, was the fact that we had bigger imports and lighter exports when it came to the beef. And I think that's where the US dollar and some of the earlier comments about the emerging markets versus the US really matter. And so we don't want to see a strong dollar throughout 2024 because that will only encourage more imports and less exports. And that, I think, was a major contributing factor to that weaker market in 2015 when our supplies were going down.
Do you have final thoughts on this, Markets Mike?
No, I just reiterate, there's a lot of risk involved in these commodity markets. It's important to understand the risks, and especially in 2024, Caesar, because we've taken the prices down a lot. I'm inclined to think that if China can come back around, it can bring the rest of the emerging markets back around with it, and therefore the markets don't need to go down to those 2015 to 2019 levels. And the best cure for demand, the best cure for low prices is low prices by bringing the demand back. And I think we're really in a critical time period right now for either establishing that or not being able to establish that. So if I could give one strong recommendation other than know your risks in these markets and how they are going to be so volatile, in my opinion, it would be to elevate your marketing, elevate your risk management, so that you're taking care of it as much as you are your planter and your combine. It's really very important to elevate your marketing this year, because 2024 could be a very important year for the rest of the decade in terms of not losing too much and being able to weather some storms.
My pleasure that you joined the show for today. Thanks, Mike.
Thank you, Caesar. It's been great talking to you.
This is Mike Zuzolo from Atchison, Kansas. This is Cesar Delgado from Back Roads of Illinois. Have a good day.